Good day, everyone, and welcome to the Market Outlook and Strategy Positioning presentation of Axis PMS for the month of December 2022. Let me start with the presentation. So, first slide entails how the year has been uh, till 23rd of December 2022, which is last week. We've seen that this year has been very challenging for the equity markets. Uh, Amongst asset classes, gold has outperformed all other asset classes, while Nifty 50 has given marginal positive returns. Mid cap has been marginally negative, while small cap index has seen a fairly big negative return this year. But if one compares it uh, for the last 11 odd years or 12 years, 6 out of 12 years, you have seen in the top three ranking, there has been mid cap or small cap. And we believe this trend can continue in future, where small and mid cap can do better in the coming period. Our next slide entails what has happened since the breakout of hostilities between Russia and Ukraine, um, and which sectors have outperformed. We can clearly see sectors like industrials, transport, agrochem, banks, uh, consumer staples have outperformed, while export dependent sectors like pharma, like IT have underperformed. In fact, if you look at last 3 4 months, you would have seen that there has been significant outperformance by banks, auto, and discretionary names. Only in last 1 month, we've seen some kind of catch up being done by pharma and IT. Our next slide discusses how each market capitalization indices have performed. From Jan 22 till date, as we mentioned earlier, there has been a stark difference in terms of performance, where large cap index, which is represented by Nifty 50, uh, has given marginal positive returns, while NSE small cap has been a big laggard in terms of performance. Here we discuss, how commodity cyclicals and export themes have performed vis-a-vis domestic plays like FMCG, auto, hospitals, industrials, discretionary, as well as banks. So the maroon line is for banks which have outperformed all other sectors, uh, and then you have domestic plays like FMCG, auto, hospitals, industrials, and discretionary names which have also done well. Only recently, domestic cyclicals have also, performed as per other domestic plays, while export themes and commodities have underperformed by a big margin. So this is an interesting slide which talks about which sectors or stocks in which sectors are close to their 52-week high, um, or they are below 30% from their 52-week high. Now, if you would have looked at this chart a month back, you would have seen significant PSUs which were very close to their 52-week high. Currently, no PSU is close to their 52-week high because of the recent correction we've seen in the last 1 week, 10 days. There are only 5 stocks out of 500 stocks which are close to 52-week high, mainly in the consumer staples place, and there are one name each in healthcare and agrochem space. In fact, majority of small caps are close to below 30% of their 52-week high. As we mentioned earlier, PSU stocks actually have done well throughout the year. Only recently they have underperformed in the last 10 odd days, which can be seen from the chart on the left. The the huge downtick in the black line shows the fall of PSUs. But still, the outperformance for PSUs is stark as compared to cyclicals, defensives, or domestic cyclicals. In fact, even in PSUs, if one looks at the chart on the right, one would clearly see that PSU banks have outperformed other PSU stocks in the last 1 year. We believe PSU's performance outperformance can sustain in 2023 as well, because if one looks at the last 11 years of history in terms of the market capitalization of PSUs as a percentage of total market capitalization, we are currently close to 12%. Historically, the average for this period has been 23%. So there is enough room for PSU market capitalization to move up. The lowest we've seen is at 8%, which was during the COVID fall. So we believe, defensive names or defense companies, PSU banks, PSU utilities, and railway sector PSUs could be the next leaders for growth in 2023. Our next slide gives us the breadth of the market and how the breadth of the market has done. So after a volatile February and March 2022, the market recovered in April 22, but declined again in May, June on account of global weakness and concerns on rising inflation. In June 2022, we reached levels of 18% of stocks which were trading above 200-day moving average, which is very close to its historical low, indicating that the market clearly was in an oversold zone. We have seen a sharp recovery in this, and now 56% of the stocks are trading above 200-day moving average, indicating it to be out of the oversold zone. So the historical average for the last 16 odd years is at 53%. Currently, 56% of the stocks are trading above 200-day moving average, which is very close to its long-term average. We believe that in the near term, market movement will be driven by macroeconomic data, interest rate movements across the globe, and near-term performance could be range-bound, at least for another quarter, till the time we start seeing signs of inflation moderating globally. This slide entails how each theme has performed in terms of value, growth, quality, and momentum over the last 2 years, as well as in short and medium term. One can clearly see that growth theme has outperformed all other styles by a notable margin in the last 6 months from the oversold zone, which we discussed earlier. Value of late has started doing well. So in a 3 month perspective, it is the best performing style and strategy, which has done well. Even for 1 month perspective, it is doing it's doing better than the markets. But in long duration, clearly momentum and value have done well, followed by growth. So one area of concern which we've always highlighted is the valuations for the market. Currently, Nifty is trading at 18.6 times 1 year forward PE, which is one standard deviation above its long-term mean. In terms of price to book value, it is trading below one standard deviation of its long-term mean. We expect style rotation and sector rotation to be key in terms of generating alpha, especially when valuations are on the higher side of the historical band. In terms of which sectors are trading above its 10-year average and which sectors are trading below 10 years average, we can clearly see that at current levels, PSU banks, energy and metal index are exhibiting valuation comfort. They are trading below their 10-year average. While on the other hand, valuations for IT, FMCG, auto are on the expensive side. In terms of IT, we believe that there is some room for further correction. That's why we are underweight the IT space. In spite of the recent outperformance of the pharma names in the last 10 odd days, we believe that the pricing pressure in the pharma sector continues to be high, and we believe companies could surprise negatively in terms of their earnings performance. Okay. In terms of Nifty EPS growth outlook, If one looks at the expected growth from FY21 to 25, we're still looking at an 18% earnings CAGR, which is far higher than the 7% earnings CAGR which we've witnessed from 2009 to 21. So the earnings outlook still remains fairly robust for Indian equities. And mind you, our earnings estimate are on the conservative side. In fact, they are lower than the street estimates. So, as I mentioned earlier, that our earnings are on the conservative side and are lower than the street estimate. We forecast our FY23 Nifty earnings to be at 813 and FY24 at 930. After Q2 FY23, we've not seen any major downgrades in our Nifty earnings estimate. Uh, there was upgrade in the financial space, which got compensated by downgrades in the oil and gas metals and Tata Motors. Since Shree Cement was excluded from Nifty 50, the contribution of cement in the overall earnings have gone down. While because Adani Enterprises got added to Nifty, the contribution from industrials went up. Uh, Financials remain the biggest contributors to expected Nifty earnings growth in FY23, 24, and 25. And that's why we have significant weight uh, in our portfolios from the financial industry. Another area which actually supports premium valuations, which we are seeing, which we saw earlier, is the improvement in return ratios or utilization of capital by companies, and which can be seen from the ROE improvement since 2013, which we witnessed not just in Nifty companies, but also the small cap and the mid cap stocks. In fact, even amongst sectors, we've seen um, profitability for auto and infra, which has improved significantly if one compares with last few years. Banks have done exceedingly well. PSU banks have even done better. And in cases like uh, uh, the only place where actually there is a lower efficiency of capital or lower ROE is media. In terms of flows, one can clearly see that in last 1 month, in spite of the fall which we've seen in the market, FIIs have been net buyers. In last 1 month, they bought close to $2.2 billion worth of stocks. DIIs also continue to lend support to the market in terms of flows. They've been buyers to the tune of $1.7 billion. After we seeing a significant outflow from FIIs during the first half of this year, post that FIIs have been net investors in Indian equity markets. In terms of DII support, again, if one looks at mutual fund monthly SIP contribution, so on an average, this calendar year, we've seen monthly inflows being close to 123 billion rupees, which is 12,300 crores. If one looks at November inflows from SIPs, it is 13,300 crores. So uh, monthly SIP inflows have been a major factor in terms of giving support to the market. We expect this SIP inflows to continue going ahead. So to uh, summarize what we've spoken, uh, 2022 has been marked by a stark underperformance by small and mid cap stocks as compared to large cap stocks. Domestic consumption dependent sectors, including banks, auto, uh, and consumers, continue their outperformance versus export driven sectors and commodities. Though PSUs of late have witnessed some correction, they continue to outperform the overall market for the year. There is further room for PSUs to outperform in 2023. In terms of breadth, markets now are fairly balanced as stocks above 200-day moving average are now just slightly higher than the long-term average. Amongst investment styles, growth has done well in 2022 and value has started doing well in the last 3 months. Stocks, uh, exhibiting quality and growth characteristics available at reasonable valuations should be our focus area. We believe such stocks can do exceedingly well in the near future. Um, Even though valuations are on the higher side and might lead to near-term volatility in the markets, we believe higher ROEs support premium valuations. Earnings have remained resilient in first half of FY23 with only marginal downgrades. We believe that our earnings estimate for FY23-24 don't have much downside because we are anyways conservative as compared to the street. In our advice to investors is that if you see any volatility in the market in the short term, utilize that volatility to increase equity allocation. With this, let me just cover our investment process, the process which we follow while managing our PMS strategies. So we follow a very active management philosophy of managing money. Our portfolio churns are high as compared to others in the industry, but that has enabled us to deliver superior alpha as compared to competition. Uh, when we want to, when we start investing, we first start looking at various high frequency economic indicators, uh, then investment style performances, including quality, growth, value, momentum, which we discussed earlier, market cap based index performance, volatility framework, sectorial performances, and we have developed a proprietary India Value Index, which help us uh, decide which sector and which stocks we need to invest in. Uh, we shortlist stocks based on top-down approach, and then we do up our bottom-up analysis. While we also use factorial models to construct portfolios. We also perform 8 accounting checks to minimize mistakes while investing. Uh, and for the shortlisted stocks, we do in-depth fundamental research analysis, which is helped by the strong 25-member analyst team uh, uh, at Axis Securities. And this 25-member analyst team is divided with in various sectors who do fundamental research. There are 4-member quantitative research team, and then there are other research team members. Typically, our portfolios consist of around 20 stocks at any point in time, which gives us enough diversification benefits and also gives us reasonable size so that if our bets go right, there is significant movement in the portfolio returns. The single stock concentration typically does not significantly exceed 10%. We also run our quant model, which looks at correlation between various stocks to provide the best possible allocation from a diversification point of view. However, the quant correlation allocation model serves only as a guidance. We do not strictly follow the allocation suggested by the model. So with this, let me just now move to our 2 key strategies. Uh, the first one is a pure growth portfolio. Now, our pure growth portfolio mainly focuses on 2 key attributes, which is quality and growth. Um, the stocks in this portfolio should rank high in terms of our quality ranking and should have earnings growth higher than Nifty earnings growth for the next 2 years. Currently, as you can see, and this portfolio is as on November end, you can see that large cap is close to 55% of our allocation, while the remaining allocation gets divided in small cap, mid cap, and cash. Among sectors where we have significant weightages, financials is the sector where we have a significant weightage, predominantly in banks. Then you have consumer names and industrials where we have significant weightages. Amongst stocks where we have high weightages include ICICI Bank, Bharti Airtel, and Varun Beverages. Some interesting names in our portfolio include Linde India, Siemens, and we've recently added Sun Pharma to this portfolio. In terms of our performance, so please bear in mind that this performance is after cost. And if one looks at the consistency of performance, it's been able to generate consistent alpha for investors in the medium to long term. Uh, the the performance which is seen below is on basis points basis. So 6.37%, 637 bips outperformance, which you can see in first year, in 1 year time frame, is a 6.37% outperformance versus our index, which is BSE 200. Please also note that the 2 year and since inception returns are on a CAGR basis. So our next portfolio is our pure contra strategy, which predominantly focuses on value and momentum as key attributes. Here, the stocks which we have are typically high in terms of their scores on value and momentum. We also do special situation trades over here in case of any opportunity which is available at low risk for playing out any open offers or mergers or acquisitions. We try and play that in our pure contra portfolio. Since momentum is a key indicator, um, we also invest in cyclicals. Currently, significant part of our portfolio is invested in PSUs. So, names like State Bank of India, Bank of Baroda, SBI Life Insurance, Bharat Dynamics Limited are some of the PSUs which are part of this portfolio. Currently, 51% of our portfolio is in large cap names, while the remaining is in small, mid, and some part in cash. In terms of sectorial allocation, financial constitutes the biggest chunk of our investments in pure contra strategy, followed by consumers and industrials. Among sectors where we have significant overweight is financials, industrials, and auto. We have some interesting names which are part of our pure contra strategy. Let me start with Bharat Dynamics Limited, which is a defense PSU major specializing mainly in missiles. And we've seen significant orders coming in for the company, and there is a host of export opportunities which are available for the company to bag. We are very bullish on its long term potential. Another name which we own is KDDL, which is a precision engineering play. It also owns a luxury watch retailing chain called Ethos, which is also listed. It's a deep value play according to us, and we are very bullish on its long-term potential. In terms of performance, if one looks at our pure contra portfolio, it's been able to generate significant alpha over mid and long term. Please note that the 2 year and since inception performance is on a CAGR basis, and our portfolio returns are after cost. So, in terms of performance, it's been able to do exceedingly well. Please note that in terms of risk profile, our pure contra portfolio has slightly more risk than our pure growth portfolio. There are some other strategies which we manage. One is the retirement or conservative strategy, which predominantly invests only in large caps. There could be some element of income generating instruments like a REIT or an InvIT, which is part of this strategy. Idea is to beat inflation and maintain the real wealth of an individual. We also manage ethical strategy, which invests in stocks which are Sharia compliant. Um, so that's a strategy which we offer to investors. And for investors willing to invest more than 5 crores, we also offer unique customization strategies, which could be a concentrated small mid cap portfolio. It could be a sectorial portfolio which a customer wants. We are able to offer that. With this, I would like to thank each and every one of you for sparing time and listening to our view. We would be more than happy if you have any queries or any suggestions. We would be more than happy to, discuss it. Uh, Thank you. Have a great 2023, and see you in the next year.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.